Some people think beating the market or even earning between 15 and 50% per year is impossible. No matter if you think you can or can't, either way, you're right. That's a quote from Henry Ford, and it relates to mindset. We'll get to that, which is step number 5. But let's go to the beginning. Here are 5 steps on how you can earn between 15 and 50% in the market. Step 1, this is pretty simple. You want one portfolio. So to give you context, there are some people out there that may ask the question, well, why can't professionals such as financial advisors and wealth managers beat the market? The reason is their job is not to build your wealth, it's to protect it. So what they're doing is they're putting money into ETFs, index funds, and mutual funds, pretty much a bundle of stocks. By doing that, you're going to pretty much match the market. Maybe a little less, maybe a little more, but that's your expectation. You're not going to beat the market, you're going to match the market. Now, to give you a reason why they do this is financial advisors and wealth managers don't have one portfolio to manage, they have multiple. So a lot of these people will have 20, 30, 40, 50, sometimes 60 customers. I've talked to advisors that have 100 or more, sometimes as many as 200 customers. And you can't be making individual trades for each customer. That's next to impossible. Now, I have talked to people that try to make individual trades for each customer. And in fact, I did talk to a guy that's been doing it for 30 years, and he says he doesn't work less than 16 hours per day. Well, my follow-on question to him was, how do you not get burned out? Don't you have any hobbies? And his response was, he actually does not get burned out, and at the flip side, he does not have any hobbies. He actually loves serving his customers, and he doesn't really do anything else. To each their own, but I have a lot of other hobbies, so I don't want to be sitting at a computer more than 8 hours a day. So coming back to you and I only have to manage one portfolio. Sure, some of you might have 1 or 2, maybe 3, but it's a really small number, so we can make those individual stock picks. We don't have to manage 50 different accounts. It's just one account, which makes it a lot easier to buy and sell stocks. Number 2, a focused portfolio. Now, if you do join Tykr, you will see within our onboarding, we do stress owning between 10 and 15 stocks. You don't want to create your own index fund or mutual fund, something with too many stocks. Then you're just going to match the market. A focused portfolio is how you beat the market. Ben Graham has said you probably don't want to own more than 30 stocks. Warren Buffett and Charlie Munger have definitely recommended less. In fact, Warren Buffett has said diversification is an insurance policy for the ignorant. What he means by that is if you don't know what you're doing, then yes, go into index funds, ETFs, and mutual funds and expect to match the market. But if you do know what you're doing and you have the right tool, Tykr, then you can beat the market. Now, in my case, I hold 10 stocks. When you join Tykr, you can see my portfolio. 10 stocks, focused portfolio. My objective is wealth building, not wealth protection. Number 3, this relates to Tykr. Find those on-sale stocks with a high 4M score. So an on-sale stock is a financially strong company within Tykr, of course. Now with the 4Ms, the 4M is a great tool. This is really inspired by Warren Buffett, then further refined by Phil Town, who really coined the term the 4Ms, but essentially goes as follows. That first M, that's the margin of safety, which encompasses the math part of investing. But a good investor should understand that investing is more than just math. You don't want to start and stop at the numbers. You got to look past the numbers, look at the business. And that's where the other 3 M's come into play. So that second M is the meaning. That's the business model. How many revenue streams does the business have, and how scalable are those revenue streams? We like to invest in businesses that can scale revenues a lot faster than liabilities. The biggest liability in a company would be payroll. The third M is the moat. How does a company compare to other companies in the same sector and industry? And the last M is the track record of the management. That's a CEO. We like CEOs that have previously built companies and increased share prices before. We don't want companies that are run by a CEO that has no business experience. Now, with all 4 M's, fortunately, Tykr does pretty much all the hard work for you. And we recently added OpenAI, ChatGPT, to help automate the 4M. So if you're curious what the 4M score is on a stock, you can simply log into Tykr and you can find out. In my case, I like to find those on-sale stocks with a 4M score of 80 or higher, or at least close to 80, because getting into the 90s is nearly impossible. Okay, moving on to point 4 is buying stocks when the market goes down. This is totally contrarian to what most people will do, but you want the market to crash. I'm not kidding. You want the market to crash. You want it to go down. For context, Over the last 100 years, we've had about 19 bear markets or recessions with an average duration of 9 months. This tells us big stockpiling, big buying opportunities are few and far between. So when the market goes down, you want to strike while the iron's hot. Even Warren Buffett has said, you want to be greedy when the market is fearful and fearful when the market is greedy. In most cases, you want to be buying more when everybody else is selling. This leads up to point 5, which is mindset. I remind myself that I do not invest in the stock market and I don't invest in stocks. I invest in businesses that have multiple streams of revenue, businesses that are selling services and products, and businesses that are removing pain for the customer. Unfortunately, a lot of people look at stocks as a stock. They don't look at a stock as a business. But if you can put yourself in that mindset and say, this is a business, and in most cases, a business isn't going to go rotten, it's not going to go out of business, and it's not going to pretty much fall apart overnight. Really well-run businesses, especially those businesses with an on-sale rating and high 4M score, those businesses are hard to bring down. A lot has to go wrong for that ship to pretty much turn in another direction. Think of it like a cruise ship in the ocean. It's going to take a really long time for it to turn. So in most cases, you don't have to worry. You're not going to lose your money overnight if you find those financially strong businesses with a high 4M score. Now this leads up to 2 case studies on how it's very possible to earn between 15 and 50% per year in the market. So this goes back to February and March of 2020. I call it the COVID dip. The market went down 30% because of COVID-19 when it first was announced. The market pretty much crashed. Guess what I did? I bought as much as I could at that time. Now you can't buy at the very bottom. There's no way to actually time the very bottom. No human or software can do that. So what you do is you buy into the dip. I usually buy every 5 to 10% down. And I did that with my stocks. And that year I made over 120%. Now in 2022 and 2023, we had the recession. Recession is when you have 2 consecutive down quarters. Some would say, well, it's more of a bear market because we had low unemployment. Okay, either way, the market severely went down. Guess what I did? Bought more, and my returns by the end of 2023 were over 100%. Now, am I going to make over 100% every year? Absolutely not. The reason is we're not going to have a crash every year. But every year, there are small pullbacks. And what you want to do is have some cash available in your broker to strike while the iron's hot. You want to be buying when the market goes down. So to summarize those 5 steps, number 1, a focused portfolio. Number 2, own between 10 and 15 stocks. Number 3, find those on sale stocks with a high 4M score. Number 4, buy when the market goes down. Number 5, get yourself in the right mindset. If you believe you can beat the market or believe you can't, either way, you're right. In my case, I know I will continue to beat the market every year. The reason is every time there's a small pullback, I'm going to continue buying more of those stocks I hold that have great financials. That means they're on sale and they have a high 4M score. Now, of those 5, by far the most important one, and this is where you can make the biggest returns, is that point number 4 is buying when the market is going down. If you hold some on sale stocks or even some watch stocks in Tykr that have a 4M score that could be, let's say, 60 or higher, if you can buy those stocks when the market is going down, guess what? You're probably going to still make some pretty good returns. All right, thanks for checking out this video. I'd love to see what stocks you guys are buying this year. If you go ahead and make a comment below, and if you like this video, hit that like button. If you want to see more like it, hit that subscribe button. And if you want to find some great stocks you can start investing in today, I welcome you to join Tykr for free.